As Chinese authorities exerted efforts to prop up their country's stock market, they have somehow put their credibility on the line. These officials now probably think that they are left with little choice but to keep resources flowing into equities. Worries that the government might pull back support measures are what appear to have sparked the fresh declines earlier this week. However, if Chinese leaders will decide to continue providing support measures, they also have to find ways that will lessen the long-term damage of their market interventions. Perhaps the best way to do this is to strengthen the market infrastructure of the country rather than to just work to boost stock prices. The governments of other countries, which have bolstered their markets by quantitative easing, for instance, have realized that it takes years to withdraw these efforts. Interventions that a government should make must be limited to efforts that uphold stability without damaging and compromising market dynamics. For example, when the Chinese government provided $483 billion in liquidity to China Securities Finance Corp. In order to support brokerages, it was implementing the type of confidence-building strategy that other monetary officials have tried before. If you want to determine whether the line has been crossed, look at the objective of the intervention. Preventing a sell-off to get out of hand is different from trying to push the market to an unsustainable level. Furthermore, a country's government should avoid the type of illogical and harsh threats that induce fear and uncertainty among investors. For example, in China, foreign investors only hold a minuscule 3% share of the market. Claiming that the market plunge is a Western conspiracy, as some Chinese authorities have done, is counterproductive. In reality, wild fluctuations in share prices that have affected China's stock market will be diminished by greater participation from foreign investors. Moreover, it is also trivial and unnecessary to encourage the police authorities to investigate and arrest short sellers. If local and foreign investors will return to the market, they have to see that there are clear rules in place. Even as the Chinese government resumes its effort for the stock market, officials should really work to come up with and employ reforms that would strengthen regulations and restore confidence among market participants. It seems like China is now paying the price for not setting stricter rules when it comes to margin lending, which might possibly have prevented the perilous levels of leverage that currently exist. Moreover, Chinese officials must enforce better accounting standards and establish ratings agencies that are more credible. Lastly, the Chinese government should make stronger efforts to stop the shenanigans that have prompted investors to pay more attention to the political connections of companies, instead of focusing on earnings and other indicators of a company's health. In my opinion, if Chinese officials really want to reduce the violent swings to which their country's markets are vulnerable, they have to provide investors with something more solid to put money in. To read more TradingBanks reviews and analysis of the latest economic and financial market events, just visit our website daily, www.tradingbanks.com.